And welcome back to It's Only Money with financial advisor Scott Brown from Edgewater Family Wealth. If you need to get a hold of Scott, that number is 407-648-1881. Good morning, Scott.
Good morning. How are you?
Oh, man, just fantastic. Still here. Still, all the events in the world are still going on, and we're back at it.
Yeah, well, as long as it doesn't end with a mushroom cloud, I think we're going to be okay. And if it does, I guess it really doesn't matter, does it?
Yeah, I mean, I saw the dumbest meme, which was like, if the stock market goes down in a war, buy the dip, and if the war ends the planet, then you don't need money anyway.
That's right.
Yeah.
It's rather pointless. We'll be those of us that survive the Holocaust or the apocalypse, I should say, we'll be fighting over corn seed and gunpowder at that point. So
yes, exactly. And we got I forgot Tammy's nickname, but Tammy is here as well.
The Russian rocket.
The Russian rocket. Yeah. Although, to be fair, not the greatest nickname right now.
No, probably not. We might have to come up with a different one.
Yeah, we might have to do a little bit of rebranding. But yep, it's already with his radio name, so there we go.
Yeah, he was doing dad jokes earlier.
I love Tammy's dad jokes.
Tammy, what was your dad joke?
Well, so what is the difference between a ruble, Russian ruble, and a dollar?
What?
A dollar.
Hey!
Oh, yeah, we're
him.
going to be here all day, folks. It's going to be fan. Tune in for this kind of insight on every Sunday morning. Yeah. So I was talking to somebody, and your name came up the other day, Ryan.
Uh-oh.
Yeah, it wasn't bad. It was about your kettle corn empire.
Yes.
Your side hustle.
It's a side hustle / main hustle, really.
Yeah. I mean, isn't it interesting, though, that a lot of people spend a lot of time, as you and I have discussed a few times on the show already, about saving and not per se saving money in terms of putting it in a savings account or a mutual fund or whatever, but more in how can I buy something cheaper than I could buy it somewhere else?
Mm-hmm.
And the reality is that's not a bad thing to do, but it's not nearly as good as a side hustle. You know, when it comes to people who become wealthy, I've seen many, many people over time. And I think it's more prevalent, correct me if I'm wrong, in your generation now. People are a little more into the side hustle. Is that not true?
The gig economy is big. I mean, because you can do so much with the way the internet works, whether it's just, driving Uber Eats or you are doing one of those like kind of a lot of freelance work is super easy to do now. My fiance is a graphic designer, and to get freelance work is super easy, just the way certain companies operate. And yeah, I don't think people want that 40-hour a week. No one plans on working at a company till the day they die now.
Yeah, I mean, I think it's an interesting transformation of our economy. I don't know that it's a bad thing. I just think it's different. My father worked at the same company for 37 years, and he had a pension, and it was all cool, and that's what people did. But in my generation, and I'm in my late 50s now, I mean, we were a little more entrepreneurial, I think, but not like you guys are. I think that the new generation of young people sees opportunity in a lot of different places, and they don't want to be stuck in one thing, which I think that's a good thing.
Yeah, it's going to be interesting because I don't think we're going to have the pensions and the things like that. So we got to figure this all out on our own at the same time, because no one's handing me a gold watch at the end of my retirement.
Well, if they do hand you a gold watch, that's all you're getting, because the pension plan has gone the way of the dodo bird. So, I mean, there are still a few, if you look at government employment, I guess there's still some pensions left there and some old school companies, but even those things are kind of being chipped away at. So I think the point is, A, side hustle is probably a better endeavor than clipping coupons, and B, you do need to provide for yourself. And that makes me touch on another topic. I was talking to somebody the other day, and we were discussing saving versus spending. And, we're Americans, so we like our stuff.
We love stuff.
We like our stuff. But, as I said to this person, I said, look, to me it seems like the savers are supported or provided for by the spenders, right? Because if you are a person who buys Apple stock versus Apple stuff, the guy who's out buying this stuff is pumping up the stock that you own. So Best way to look at that is savers are often subsidized, if not always, by spenders in this economy. So if you say, which side of that equation do I want to be on? It's easy to spend, right? That's kind of a simple thought process. I like that. I want that.
Yeah, it's a lot of times just one click now.
Yeah, Amazon makes it easy for you to spend pretty quickly. I would say the other side of that is if you're a saver, though, maybe you put off some of your spending to allow the other spenders to subsidize you till you get to a point where your savings will allow you to be a spender, but on a better and more regular level. Does that make sense?
Absolutely.
Really? Good, because I wasn't quite sure what I said there.
Well, no, you got to have the people buying the stuff, which shoots the stock up. You get the stuff, but you don't, you still have to then buy stuff as well.
Yeah, I mean, I think the goal is to accumulate, and again, I'm not just talking about stocks or bonds. It could be real estate. It's something that's income producing later in life. You say, well, I'm 25 or I'm 30, and when I'm 40 or 45 or 50 or 55 or 70 or whatever it is, if I can accumulate, again, if I can use my money to accumulate assets that produce income versus accumulating stuff, right? Because stuff ends up in your garage. Stuff is the things that when you're dead, your family's all mad at you because they have to clean out the garage and it's full of stuff that you haven't seen or touched or looked at in years. But if you accumulate assets, especially dividend-producing or income-producing assets, again, real estate, stocks, bonds, whatever it is, at some point, those things that you've accumulated, those assets, those income-producing assets will produce income for you to then enjoy for the rest of your life versus the stuff that's broken in your garage that your family's now mad they have to throw away.
I just got an influx of stuff/assets. I don't know if you know this, Scott, and you maybe can help me how to do this, but my mom is selling her house. She's just a bunch of houses, and one of them she's selling. And in the house, she found a box, and I don't want to brag here, of Beanie Babies.
Wait a minute. Wait, Beanie Babies?
Beanie Baby.
Vintage Beanie Babies.
Vintage Beanie Babies, including the very rare at the time Princess Diana Beanie Baby.
Is that real?
So I would say that stuff. Well, okay, remember Beanie Babies?
I do.
And at the time, people legitimately thought that was an investment. I remember like my mom buying these and saying like, oh, in 10 years, this Princess Diana one. Yeah. And it's funny because so she was just going to just give them to Goodwill, right? And I was like, you can't do even in my dumb brain in 2022, I'm like, we can't just give away Beanie Babies. These are obviously worth something.
Clearly.
Even to the point where I went on eBay just to see, and they're listed on there. I mean, like, there's obviously the ones that like get $5, but then like there's some guy who's been sitting there forever with the Princess Diana Beanie Baby, and it's like listed at $500,000.
Yeah, I think that'll go in the same category as finding a GameStop stock certificate in 20 years. They'll have a similar value. Yeah, I mean, it's in there's pet rocks. I remember there was Precious Moments was a thing. They were like these porcelain dolls, and I remember knowing some people who were convinced if they had these precious moments.
My mom had those too.
Yeah, there you go. So she was very diverse. She had the Beanie Baby category covered and the Precious Moments.
My mom, smart lady, diversified.
Yeah.
But it was like a lot of that. And it came from my grandma who had Hummel bells. And collected these Hummel bells that are always supposed to, but those are actually like sort of worth something now since I've looked that up. But it's amazing what people do that aren't investments that they'll call investments.
Yeah,
but it's just stuff.
It's just stuff, and some stuff accidentally. I think more than anything, you'll find 100 years later in your great grandma's bag that you found somewhere in the shed or up in the attic. Yeah, you'll go on what is that show, the Antique Road Show or whatever it is, and accidentally somebody's got a $50,000 desk or something, which they had no idea. So that does happen.
But that's like a lottery ticket.
It's pretty much like a lottery ticket. I mean, oftentimes there's somebody on there and they're like, I think it's worth, $70,000. The guy's like, no, I'll give you $10 for it. So that happens more often than not. But getting back to my point, because I not that I don't want to talk about Beanie Babies all day.
Sorry about that.
A riveting discussion. But is talking about savers and spenders. And, spenders, whether they're buying cars or they're buying phones or they're buying software, whatever they're buying, if they're always having to have the next thing, the next piece of equipment, or the nicest car. They lease a car every 3 or 4 years, versus you who's buying Ford stock or Tesla stock or Apple stock or whatever it is. That's a legitimate way to look at the economy, is to say, which side of that equation do I want to be on, and how advantageous is it for me to wait maybe one more iteration of that iPhone and save that money?
Well, I can't believe you're going to have to wait and thus invest in this commercial break as we come back and talk a little bit more about that with Scott Brown, financial advisor for Edgewater Family Wealth. If you need to talk to Scott, that's 407-648-1881, and we will be right back. All right. And welcome back to It's Only Money with financial advisor Scott Brown of Edgewater Family Wealth. You can reach Scott at 407-648-1881. I'm Ryan Holmes, and we also have the soon-to-be rebranded Russian Rocket Tammy with us this morning.
Hello.
Yeah. Well, Scott, right before we went to break, you're talking about saving versus spenders. And, I mean, like, the point in life that everybody wants to get to is to be a rich person who then spends on stuff, right?
Yeah.
Like, because I don't know, that's the dream, right? You're rich, you get the big fancy car, you show off to people, and how does that even compare? How am I supposed to save and buy the Mercedes at the same time?
You know, it's funny that there's a famous book out there, and I think possibly if you could only read one book about investing or saving or wealth as a young person or an older person for that matter, it's The Millionaire Next Door, which is it's been, I think that book's 40 or 50 years old now. But so if you look at the studies they did early on, and now we're talking about self-made millionaires. I'm not talking about lottery winnings or rich uncles or anything like that. But if you look at self-made millionaires, what would you guess the number one vehicle driven, and this study was done, granted, 20 years ago or so, but what would you say the number one vehicle those self-made millionaires drove?
I'm assuming it's going to be like a Land Rover type of situation, like a fancy SUV.
Yeah, so it's a Ford Taurus.
What?
Yeah, back in the day. Now, what the equivalent of that would be, I don't know, but back then the number one vehicles were a Ford Taurus, a Ford F-150, and a Toyota Camry by self-made millionaires. And you ask yourself, well, why would that be? Why would somebody drive a Camry who's a millionaire?
Right.
And it's because they understand the value of Camrys, Toyotas. I mean, I'm not pitching Toyotas here by any stretch, but
sensible cars.
They are sensible, durable, long-lasting vehicles. The spending on Ferraris and Porsches and things like that do not lend themselves to becoming a self-made millionaire, right? Because if you get the cart in front of the horse and you say, well, I made $100,000 and now you go buy a Porsche with it, now you got to start over again. Rather, if you buy a Camry and put that money in a savings vehicle that maybe pays you 3, 4, 5, 6, or whatever the rates were at the time, that's how you begin accumulating, so that maybe when you're 58 or 61 or 63, maybe that vintage car you finally wanted you could get, or that you wanted you could finally get. But that is not the operating procedure of most millionaires. If I see a 35-year-old driving a 911, like a brand new 911, $150,000-$160,000 car, I'm comfortable that car is leased. More, not always, of course, not always, but more often than not. And I used to tell my kids, that's big hat, no cattle, as they say in Texas, right? He's the guy who has the giant hat and he's driving around in the Cadillac. He doesn't even have a ranch. He's just got the hat, right? So that's one way people look at that, and that's certainly how that is said in The Millionaire Next Door. And the other thing I would say to you is, a lot of times people want to upgrade their homes all the time, right? They bought a house when they were 24, 27, whatever it is, and it's not a big house because they couldn't afford much, and then over time they realized their income went up a little bit, so now they can get a little more credit, so they go from the 2,000 square foot house to the 3,000, and they do this repeatedly. The average millionaire in the studies done back when they did these for The Millionaire Next Door lived in their home 31 years. Meaning they weren't always upgrading because it made them feel good or they could brag to their friends. They lived in the same house. They took care of that house. They maintained it. It was well landscaped. These are all attributes of millionaires. Another thing they studied was that the average millionaire in that study had never spent more than $300 on a watch.
Man, you take all the fun out of being a millionaire.
I know.
But it totally makes sense. Like for me, whenever I see somebody do that, like they'll go in debt for like an expensive car or something. I'm like, you're hurting yourself down the line. Like I feel like it would. It hinders you. It literally slows you down buying a super fast car, you know?
Right, because you're going to buy a 911 that goes 170 miles an hour. Where are you going to do that again? What street is that legal?
The insurance, you're going to get tickets. It's just on top of all of it.
Yeah, it's really a path to nowhere, and it just gets. I mean, think about like I bought a new car when I was young. I bought a new Mustang. I was so excited. It was the greatest thing ever. Couldn't wait. You know that you buy that new car and you park it in the back of the parking lot so nobody gets near it. And then when you're walking away, you look at it 4 or 5 times, and then you come back out and look at it again.
You back it in every time you park.
Yeah. Oh, I did all that. And then about 3 weeks later, there were crumpled up Big Mac wrappers in the back and old French fry bags, and it smelled like an old shoe because I didn't care anymore. You know, I was a young man. I was foolish. It's just if people would walk themselves through where they are. You know, someone famously said, think about this decision, what it means to you in 5 minutes, what it means to you in 5 hours, what it means to you in 5 days, 5 weeks, 5 months, 5 years. And if you think of every decision, especially financially or otherwise, frankly, what it would mean to you 5 minutes, 5 hours, 5 days, 5 months, 5 years from now, you probably will make better financial decisions. Because if you say, I'm going to go out on a limb here, I can't really afford that $700 a month car lease, but boy, that Mercedes is going to look good in the driveway. But you think, how am I going to feel about that car in 5 months? And I can promise you, you're not going to feel that great about it. You're going to have the payment, the excitement of the purchase is going to wear off, and then you're going to be like, what have I done?
Is there a rule of thumb for like what your income is versus like what you should spend on things like cars, or is it all just willy-nilly and just don't buy expensive stuff?
No, it's not. It's not. I mean, Tammy was just showing me a study he saw on, you know, the higher your wealth is, the less of your income you spend on cars and houses, which makes sense because you're wealthier. But I think you start the other way. I think you start with, what do I need to save to get to where I'm going? So if you say, well, the average person has trouble saving 5 or 6% of their income, which is true, unfortunately, in this country. It's gotten a little better, but not much. You really should say, look, I'm going to start by saving 10%. And I'm making the number up, but 10% is certainly a good start for a young person. And then work backwards off that. I want to spend 20 to 30% of my annual budget on housing, maybe 10% on transportation, whatever that number is. But stick to those disciplines. Don't drive by the lot and say, wow, the new SL's out or whatever. I don't even know what Mercedes.
For me right now, it's the F-150 Lightning that's coming out.
Yeah.
And my credit's good. I got some extra cash. And I'm like, I could definitely get it, but it's also like a $65,000 truck.
Yep.
And I have to like reel myself in like all the time. Like I'll sit on the websites. I'll just look at it, you know, but impulse control, you know, I think that's the hardest part, you know, because Americans, we want it now. We want it. It's flashy. We want it right now.
Yeah. So I mean, it goes back to that dopamine fire I talk about when it comes to trading stocks. When it comes to, I mean, I hate to say it, drug use. We've talked before about when they do studies, they do MRIs on somebody's brain and they compare the trade of a stock to using cocaine, and the areas of your brain that light up look very similar in both cases. And I think it's probably true of a new purchase. We get excited about buying a new car, or new clothes, or new shoes, or jewelry, or whatever your thing is. And I think that's why Amazon's so successful, because it's a constant dopamine fire. Like, oh, I can buy that. Oh, I can buy that. And you don't have to go anywhere. I mean, I hate to say this, but I've seen people who have houses full of unopened Amazon packages. And it's simply an addiction in its own way, these purchases. And I mean, I used to say Madison Avenue in New York was where a lot of this marketing began, so I'll still use that dated term, but Madison Avenue gets it. They understand how to market to you, how to sell to you, how to circle back to you and convince you that, you know, you missed out on that shirt last week, but by golly, you're going to get that shirt this week. So, I mean, that's you have to, if you understand the dynamics of consumerism and to some degree the American mentality when it comes to stuff and not wanting your neighbor to have better stuff than you do, then you can begin to overcome that and kind of rehab yourself, for lack of a better word, and become a better consumer, and conversely become a better saver.
But you don't know what it's like, Scott, when packages just show up at your door and it's like Christmas every day.
It is. It is.
To be fair, in my scenario, it's not for me. My fiance orders everything through Amazon. So there's always packages, and I'll still get excited, and then they're not for me. It's always something useful for the house.
That's annoying.
Isn't it?
I mean, who wants that?
Well, she's responsible at least. Where it's like, oh, what is this big package? She's like, it's an ottoman. And I'm like, oh.
Yeah, it's like buying tires, right? When you go spend like $600 on tires, and you're like, that sucked. I don't like tires, but I need them.
Well, Scott, I got a question for when we come back. And all the financial advice I see it always starts with like, rich people don't want you to know this. Mm-hmm. My question for you when we come back is, are there really things that rich people don't want you to know? And we'll be right back with more It's Only Money with financial advisor Scott Brown of Edgewater Family Wealth. You can get a hold of Scott at 407-648-1881, and we'll be right back. And welcome back to It's Only Money with financial advisor for Edgewater Family Wealth, Scott Brown. And Scott, before we left, I said every bit of internet financial advice I ever see, it says, rich people don't want you to know this, and then they explain something that rich people don't want you to know. Are there things rich people don't want you to know?
You know, those rich people, they're just, nobody likes them.
Because they don't want you to know things.
They don't want you to know things, because then they wouldn't be rich anymore. Yeah, so that's kind of an interesting scarcity sell, I suppose, that, rich people don't want you to know this, but I'm going to, for $19.99.
Yes. You always have to purchase a pack.
Yeah, I mean, it makes sense. It's $19.99 that you would now know what rich people know. It's what's funny about that is it's the exact opposite. So if you go on, and I'm not pitching LinkedIn or anything like that, but most wealthy people like the Warren Buffetts of the world, or the Mark Cubans, or the Damon Johns, or, take your pick, make a list, Richard Branson, they're open books, man. They will tell you, this is how I did it, this is how it works. But you know what people don't like about that?
That it's free?
That it's not that it's free, but it is hard. It's not complicated, but it's hard. So if the story is, well, I worked 3 jobs for 4 years, I rarely slept, I poured concrete in the summer, and I tarred roofs at night. In the meantime, I learned how to code, and I read every manual. If you're Mark Cuban, I read manuals on how to code, and I read this, and it took me 7 years, and it sucked for 6 years, and then 8 years I was bankrupt again, and then something terrible happened, and then 15 years later I was rich. Nobody wants to hear that.
No, we don't want the hard work.
They want $19.99 a month makes you rich, right? So the funny thing about most successful, quote unquote, rich people, and we've talked about the difference to me between successful people and rich people, one being the monocled monopoly guy that you and I both admire a great deal, and people who have worked hard and over time accumulated wealth. Not the least of which is Warren Buffett, who will tell people on a regular basis, look, you just buy quality issues, you hang on to them for a long time, you accumulate, you let dividends accumulate, you buy more stocks, you save, you spend less than you make, et cetera, et cetera, et cetera. Nobody cares about that. Again, and I know and it'll probably start happening a lot now. If you watch the financial networks, you'll start to see ads for gold coins, right?
Yes.
And whenever things are going poorly, the gold coin guy comes out. And usually it's some former Treasury employee or secretary of this or some network host who's saying the following to you, Ryan. Listen, people, the world is getting ready to end. So I want you, the only currency that's going to be available when the world ends, Ryan, is going to be these Eagle gold coins.
Yes.
So I want to sell you these Eagle gold coins. So what this person is saying to you is the world's going to end, and the only currency that's going to be available to us are these gold coins. And he knows this, yet he wants to sell them to you. Right?
Yeah, he should keep all the coins.
He has them already.
He could be king of the apocalypse.
But he is so kind and generous that he's going to sell them to you. So again, the old "be wary of the naked man offering his shirt" adage applies here.
But the word bullion is so nice.
It is. It rolls off the lips.
But how am I supposed? Okay, so speaking of impending doom, how am I supposed to save money right now when gas is the most expensive it's ever been?
Yeah.
It's $4 a gallon right now in Florida. I can't believe it. What do I do? Do I do the gold coin thing?
Yeah, you definitely got to buy gold bullion, right? I mean, that's the only solution. But Tammy, is what he said actually accurate? Is it the highest gas prices ever?
If he is 6 years old, yes.
Darn it.
Yeah, you seem to me older than that. So you're fine, yeah. So gas prices past 20 years, we had 2 points in history when we had, in the past 20 years alone, we had 2 points where gasoline was higher. And those were in 2008, and we all know right before the crash. And then we had in 2012 as well. So it's not the case.
Yeah,
this happened before.
And I don't know the statistics on this, or I don't know the inflation-adjusted price of gas, but I can tell you it's not high. So, and I say that, I know people are going to, what is he talking about? It's not high. I mean, I get that it's expensive to fill your car up right now. I'm not denying that. I have a big Dodge truck, and filling that sucker up is
the old kettle corn truck that gets 9 miles to the gallon right now.
Yeah, so I feel the pain, but my point is inflation-adjusted gas is, it's not gone up much over the last 30 or 40 years. So comparatively to other goods and services, and certainly to things like college tuition and housing, gas has not gone up a whole bunch. That doesn't mean it isn't painful right now. But I also would say that when you think about petroleum in this country, yeah, I mean, we do import some gas, and we used to import some from Russia until, I guess, yesterday or the day before. The reality is this is a nation that's almost self-sufficient in its oil production, and maybe this will be the impetus to get us fully there. I don't even care about the politics. I know people like to make political hay out of these things. It doesn't matter. The bottom line is we can get there pretty easily. Does that mean we shouldn't explore alternate sources of energy? Absolutely not. These are things we can talk about in conjunction with becoming energy independent in terms of oil production. And will gas prices probably continue to be a problem for the foreseeable future? Sure, probably for 4 or 5 or 6 months. And recognize that in the summer, gas prices always go up anyway. So is this part of some big conspiracy other than the issue in Russia and the Ukraine, or Ukraine, as I've been told to call it now, and Jamie tells me not to say the Ukraine.
There's only one.
There's only one of them, right. So it's Ukraine. But I do think once this issue hopefully resolves itself, we'll see gas prices return to some level of normalcy.
Yeah, I mean, that one is the thing that hurts me the most. I live very close to the station, so I literally didn't know for a minute, right? Because I didn't have to get gas for like 2 weeks, right? Yeah. And so the sticker shock was there, and I had the immediate feeling of like, I need to start hoarding money and putting my money into gold bullions and things like that. So in a situation like this, how can one continue to grow financially?
Well,
or is there you just don't sometimes, and that's
sometimes that's true. I mean, when we're talking about building wealth, some people think, well, that's easy for you to say, but I'm making minimum wage or $15 an hour. I have a family. I get all those things. This is not I didn't say it was easy, but people do build wealth who are of nominal means in the beginning, right? If you're struggling with a family, maybe you're a single parent, who knows? These are all challenging issues. But creating a situation through side hustles or working at night or driving Uber in your spare time, and I get it, it's not easy. What I would say is people make it more complicated than it needs to be. It's not complicated, it's just not easy, if that makes sense. So I think, again, building. Here's what I do know. If you don't ever think about it, or you don't talk about it, or you don't sit down at your kitchen table for 15 minutes and figure out a budget, take out a yellow piece of paper and say, well, this is what I spend and this is what I save and it'll never happen. You are self-defeating if you don't take a minute to look at these things. Talk to your significant other, talk to a parent. You know what you should do is talk to an older person, talk to a person who you see as successful. That's another thing that I see, a reluctance among young people to say, look at that rich person or that wealthy person, and then not ask them for advice. Because I will tell you, when I was young, I did that. I said, "Ooh, how do you look successful? Tell me about how you did this." And the answer was never gold bullion, surprisingly. So I know that's disappointing to you, but I think that first and foremost is to be curious and humble. Start there, and I think the rest will take care of itself.
Yeah, I know a few successful people, older people, and their answer is never like, "Well, just willy-nilly it sort of happened, and I don't even know what I bake." Like, it's never that. It's always like your answer of like, it was hard, I struggled, and then I have a budget, and I follow this thing, and I got my investments, and it's like, oh, darn it.
That sucks. Can we start over again? Tell me something else.
But I mean, I've seen things like a study I saw most recently was like more people spend time on social media by like 1,000% than they do on their actual bank app.
Oh, for sure. For sure. Yeah. And again, we talked, I think it was last show, we talked about vacation planning is people spend considerably more time planning a vacation than they do their retirement, which lasts hopefully 20 or 30 years. So, yeah, I do think part of it's a lack of planning. I also think that for people, it's a little intimidating. They don't want to look at it because they know it's not pretty. So they spend a lot of time avoiding rather than engaging.
Oh, my God. The first time I did a budget, I realized how little money I had. And it was so scary that I didn't want to do the budget. But it was like legit. Like, I was like, oh, I really only have like $120 at the end of all of this stuff. And it made me not do it for like 3 months. And I was like, no, I got to figure this out and cut costs and do that kind of stuff. But you know what it was, Scott? Boring.
I understand. But what gets measured gets changed, gets
You're
fixed.
Absolutely right. And if you want to get measured and changed, Edgewater Family Wealth is where you want to go. That's Scott Brown at 407-648-1881. We'll be right back with more It's Only Money. And welcome back to It's Only Money with financial advisor Scott Brown of EdgewaterFamilyWealth.com. You can reach Scott also at 407-648-1881. And it is the last segment of the show. Hope everybody's enjoying their Sunday. Scott, we have now a Q&A portion of the show.
Fabulous.
Because we asked for some emails last show, and we got some really good ones. And I was hoping I could run a couple of these by, if you don't mind.
Fire away.
All right, first one I have is from Adam in Longwood, and he says, he seems to be a little bit worried, basically boils down to, in light of the Ukraine crisis and everything going on, should I be changing my portfolio to adjust with the market volatility?
Well, the short answer is no, but I'll go into that a little bit. So I think we talked about this a little bit last week, but it's the planning that needs to be done for a crisis needs to be done before the crisis occurs, right? So we talked about digging a bomb shelter while the bombs are falling. That's generally not a good strategy. So I think what I would emphasize, and we're going to get back into the boring part of the conversation, which is to say planning is critical. But planning happens all the time, and it happens each year, hopefully a couple times a year when you're looking at your account. Whether you're managing your own money or you have an advisory relationship, part of the beauty of an advisory relationship is these conversations where you cover what if this happens, what if that happens, and then you adjust for the what ifs. You don't adjust while the what ifs are happening. So the first thing I would say is the planning part is critical. I would not change anything right now, although I obviously don't know the individual workings of that portfolio. I would say doing something during a time of crisis almost never works. And speaking of crisis, Tammy, since the war broke out, so we can give context, Ryan. How much is the S&P 500 down since the day the war broke out?
1.4%.
Okay, so if I said to you, Ryan, that a full-blown war, Putin is going to invade the Ukraine with hundreds of thousands of troops, bombs are going to be falling, planes are going to be flying, bad stuff's going to be happening, and I said to you, the market's only going to be down 1%, would you have believed me?
No, when he said 1% now, I wanted to just openly call him a liar.
Yeah.
Because I was like, of course it's down 32%.
Sure.
There's a war going on.
Don't you know? What's wrong with this stock market? And then the NASDAQ, which is the more volatile and more tech-oriented index, how much are we down there?
3.4.
So 3.4. So if I said to you again, a full-blown war is going to break out in Eastern Europe, but you're going to be down 3%. Is that going to be okay? Most people would probably go, yeah, that's cool. Don't you think?
I mean, losing 3% is like that might as well be nothing to me. I mean, like 1%, 3%. I can't even tell you what that would be on my account, but I can't imagine that I would be bothered by it too much.
No, and I think most people, if you would ask them, in their minds, they go to, well, we're going to be down 30 or 40. And listen, we still could. I mean, that could still happen. But my point is, I think there's a Tom Petty song that says, the worst things I think about never happen anyway, right? So we go to these extreme places in our minds and say, well, if war breaks out, we're going to be down 80% or 100%. Well, right now we're down 1 in 3, depending on the index we're talking about. This is, again, I want to be super clear here because somebody will call up and say, you're sad. No, what I'm saying is...
We get emails now, Scott.
Yeah, we do get emails, and that's what those emails sound like, by the way. That's the voice they make when they write them. You said that, this couldn't happen. Well, the truth is it still could happen. We could still go down 10. We could go down 15. We could go down 30. But a lot of the reason we're down this year... outside of the war issues is inflation, it's supply chain issues, it's corporate profitability, there's employment issues. We're having trouble getting workers in certain sectors. So there's 10 different reasons why the market's down this year. The war is one of them, but that is clearly, by the data that we were just given by Tammy, is not the primary driving factor right now.
Now, is inflation like the stock market where it has to go down, or is this like 7%? This is what we live at forever now.
Yeah, I mean, clearly not. I mean, we've averaged less than 2% inflation for the last 20 or 30 years, which has been historically low, to be fair. But for those of us old enough to remember the 70s and 80s, those numbers were considerably higher back then. We came through the mid 70s with all kinds of issues that were economic issues brought on by a variety of factors, and then we had an administration that decided to break the back of inflation by raising rates really quickly, which led to 8, 9, 10% inflation. People would say, well, I'm getting 12% on my CDs, and I'd be like, yeah, that's cool, but you were also getting 10%. You were paying 10% in inflation every year. So, mortgage rates were 8, 9, 10% back then. So we don't really want high inflation, and I would argue that some of this inflation is transitory. I'm certainly not an economist, but I think most economists would tell you that some of these things that are supply chain based, once they start to subside, we'll see inflation come down a bit. Will it come back down to 2? Probably not. But certainly I think some of that's transitory and will pass.
Well, that's going to make me sleep very well tonight.
You're welcome.
Every time I do this show, I'm like, one time I learned that Russia's the size of Texas, and that made me sleep better. And now I learned that, and now it's very nice to be here.
It's all about your sleep quality. That's why I'm here.
Exactly. I appreciate that. We got another question from Alicia in Orlando, and her thing is all about tax time is coming up. So it's April 18th this year.
Is it the 18th?
I think they moved it to the 18th for whatever reason. And with tax time coming up, are there any deductions that I should get for the last year that I could be missing? It's a little vague, but
I get it. I see where she's going.
Okay.
So, yeah. So, I mean, the obvious ones, IRAs. IRAs are, if you're doing a deductible IRA, well, I guess whether you're doing a deductible one or a Roth, but if you're doing a deduction, if you're looking for a deduction, I think we can put a person under the age of 50 can put around $5,000 a year into an IRA. It might be a little more or a little less. I don't remember the exact number, and deduct it for last year. So even though 2021 is come and gone, before you do it before your filing deadline, and you get with your accountant and say, look, I'm putting this money in, that's a deduction you can still get for the tax year 2021, even though you made the contribution in 2022.
So I put money into an IRA, and that money's not taxed.
If you do what they call a traditional IRA, that is correct. You would put that money, as long as your income levels, and again, get with your accountant on these sort of things, but as a general rule, if your income is not substantially high, meaning over $150,000 or so a year, you should get some deductibility on an IRA should you make that deposit each year. Now, for young people, it's arguable they should be doing a Roth instead, right? Because a Roth is tax-free forever. You don't get the immediate gratification of the deduction, right? So nothing exciting happens when you do it. But over time, if that money grows, it's tax-free for the rest of your life versus the deductible version, which when you take it out at retirement, you have to pay your taxes to Uncle Sam.
Is it really such a big hit to take money out of one of those accounts before it's, time?
Before it's ripe?
Yeah.
Yeah, so 59 and a half is the magic age where there is no penalty, right? So if you have IRA or 401k, what we call qualified money in the business, and you've put it away and deducted it, the rule is you may not take it out till age 59 and a half, or if you do, you will be penalized 10% on top of the income tax. So so sometimes somebody will say, hey, I've got 50 grand in my IRA and I want to buy a car with it. And I say, well, that's great because you're 40 years old, but if you take that money out, you're going to pay 40+% in income tax. So for you to get the money to buy your car, that 50 grand that you pull out, you're going to pay $20,000 in taxes. So add that 20 grand to the price of that car, and yes, that is a substantial problem.
But I think I just found a loophole in the system, Scott, and correct me if I'm wrong. So I got a bunch of money.
Bunch of money.
And I don't want to get taxed on it. I'm 59 in 1 day to 59 and a half years old.
Yes.
Can I throw all of that money into an IRA or a 401k, something like that, and then none of that money's taxed, collect it the next day?
Yeah, that's not going to work.
Ah! Yeah. I was like, I figured out the system here.
Yeah,
you game the system.
Yes, you're gaming the system.
You always want to do things the boring way. I'm here for the loopholes.
I mean, the government has thousands of people working, trying to outsmart you, which I know it takes thousands to outsmart you in this area. But
did you just hear my brilliant plan?
I did hear your plan. It was fantastic. But yeah, it's not going to work quite that way.
Oh, well, that's too bad. I'm going to keep coming up with these, Scott. I'm going to keep coming up with them.
Keep working at it. I mean, it's rich people don't want you to know this.
Yes, and I assume because of me, anybody making over $32,000 is a rich person in my book. This is a funny email. This one is from Jeff from Ormond Beach, and he says, Ryan talked about the Dum-Dum Index on your show, where it's just regular people moving their money, is what he's talking about. How is the Dum-Dum Index doing overall in a scary time?
Well, what you're talking about is the average investor sentiment.
Yeah, that one.
Yeah, Dum-Dum Index works as well. Those Ormond Beach people, they're on top of things. But it's working the way we would think. People are panicking. We're seeing outflows in certain asset classes that we wouldn't normally see because people are seeking safety. And by seeking safety, it means they're selling volatile assets while they're down, unfortunately. And what will happen to those people is they'll wait for them to come back up and buy them back, which, as we know, is not a process that works very well.
Nope. But a process that does work very well is using Edgewater Family Wealth. And if you want to send a question in to Scott, you can go to edgewaterfamilywealth@raymondjames.com, or you can give Scott a call again at 407-648-1881. Great show, everybody. Tammy, Scott, I'll see you guys next week.
You got it.
You got it, man.
Thank you.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, there are people, there are regular people.
Now that guy I trust.
Yeah,
see, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.